Hello traders and welcome to a new day trading strategy video of mine. In today's video we're going to be looking at order flow in combination with stop loss, hunt, market structure, and how to execute on these new methods. So if you haven't seen my videos on order flow analysis, I did a 4-part series on it. I recommend you watch those first before you watch this video, because part 1 and part 2 of my stop loss, hunt structure, market structure playlist worked more with price action and volume and price structure. But this video is going to get more into using TensorCharts.com, which is an order flow website for crypto. So I'd recommend that you watch those 4 videos, or at least maybe probably one of them, before you watch this one. So before we start with looking at these new indicators, let's do a recap on stop loss hunting and why it works better than other indicators might. Well, there's a retail institution relationship in crypto, in really every major market, Forex, futures, the stock market. And these institutions carry high amounts of volume. And in order to trade with high amounts of volume, you need high amounts of liquidity. To get their liquidity, what they need to do is put their limit orders at spots where there's going to be a large cluster of stop losses. And the reason that they want to do that is large clusters of stop losses. When those stop losses are triggered, they're going to execute as many market orders. Those market orders are immediately going to execute on institutions' limit orders. So that's exactly what the institutions need to happen to fill their orders in order to capture profits. So what this kind of relationship is called is liquidity pools. And liquidity pools are typically right below support or right above resistance. This is where, when price does move slightly below established support, price will likely go very quickly below support as many stop losses are hit. There's a high amount of liquidity for market selling, when price goes slightly below support, and that's going to potentially fill many institutions' limit buy orders. And when we place our limit orders around these stop loss clusters, we can hope to hopefully get filled, and then when price closes back in the trading range, to try to capture as much of the profit of the uptrend as possible. So beyond these stop losses, not only when price moves below support do we hit stop losses, but 2 other things happen as well. One is that some traders might actually flip their positions. So a trader who would be long, let's say he's long and he buys, midpoint of consolidation, price goes below support. And he market sells out of panic because he thinks the price will go lower. It's moving lower on high momentum, high volume, which later turns out just to be a price low tail, but he doesn't know that. And market sells. And then after he does that, he actually enters a short position to try to capture the profit and to mitigate some of the loss he just had. So that kind of flipping of a position is going to execute as not only one market sell order for him, or it's going to execute as multiple market sell orders as he exits his position with a market sell order, then flips his position into a short with another market sell order. So this is just going to provide a lot of liquidity for institutions to step in and to accumulate their positions. And then the second reason that occurs is when price dips below support and then consolidates or moves a little bit above. This is where many retail traders are just going to look for a better price to sell at. They've already decided in their mind that they want to sell. So when they see price actually coming to a more expensive price, a better price for them to sell at, they can still sell, and institutions can still accumulate positions on the run back up. So let's just do a quick 60-second recap on part 1, part 2 with the kind of market structure that we talked about before we're looking at order flow. We talked about 3-point stop loss reversals, look like these. We talked about 4-point stop loss continuations, contractions, basically just a pennant, also known as a symmetrical triangle, where price isn't triggering any liquidity until the very end. We talked about expansions. This is when the market expands to a higher high and expands to a lower low and then closes back within the trading range. Typically, price continues moving in the direction it had previously moved. So if it moved up, it'll probably continue to move up. If it moved down, it's probably going to continue to move down after this type of formation with that higher high, and then price goes lower. But sometimes price will just continue to make another high, or just to make another low here. No, another low here, or just another high here. Yeah. So that's just a quick, like a 2-minute crash course on institutions retail, looking at liquidity pools and stop loss hunting that will occur. and the types of formations that we're going to look at for that to happen related to price action and volume. Because my first two videos talked about price action and volume and how that worked within the structure, but this is going to be a little bit more advanced with order flow analysis. All three of these types of tools are from tensorcharts.com, which currently is a free order flow site for cryptocurrency trading. And I just have to say, quick disclaimer, it is a phenomenal site. I really couldn't thank David enough, the creator of this website, for what he's done here. There's so much useful information that I've made profits off of, which is really nice. So thank you to David. Okay, so first let's look at tool number one for spotting these types of stop loss hunts, the order book. The two types of price patterns that you're going to see is one, which is going to be quite straightforward, which is just a cluster of orders located right below support or right above resistance. And this is institutions just basically telling you that they're putting their limit orders where a lot of stop losses orders are likely going to execute on. So an example of that would be this. I just took a screenshot of this about, I think, an hour ago. And this might look confusing at first if you haven't seen order flow or the order book overlaid onto price chart. But let me explain this here. So these green, and this red, that's going to be orders over 100 at a certain price level. So when you see clusters of green or clusters of red, that's going to tell you that there are many limit orders there. If you can see here, where are the majority of bids, offers? The majority of bids are actually around 94.50 to 9,500. That's where the majority of these bids are. So from about here to about here. So what does that tell me? Well, that tells me that there are a lot of there's a large institutional presence likely at this level, and if these orders hold, when price moves below support here, that's probably going to trigger many traders' stop losses, many retail traders' long stop losses here, because established support, 1 touch, 2 touch, 3 touch support. There's probably lurking a large amount of stop losses at around 94.90, 94.80, right below 9,500 would make a lot of sense for retail to put their stop losses at. And that's going to begin to execute very quickly with price probably tearing right down to these levels and filling the institution's limit buy orders. One thing I will say about this type of thing is this is not short-term or long-term. So when price does eventually, even if it does, it might not. If price does move below support here and triggers the stop losses to fill the institution's buy orders, price might just go up slightly with the accumulation by institutions, or price might actually just continue the uptrend. We don't exactly know, but that's where other types of analysis come in, like Fibonacci's, traditional indicators. But this is more for filling our order at the best possible price. That's the goal of stop loss hunting. So this looks to have a strong institutional presence, and we also see a strong institutional presence right above resistance. So if price was able to go above resistance, we might actually be hitting many retail short stop losses to fill many institutions' offer orders, sell orders, basically. So this is what you want to look for with these clusters of orders located right below support or right above resistance, and we see both of those. For the institutions are ready for traders to hit their stop losses and to take advantage of them. One more thing is you can see here, these yellow dashed lines that I have, that yellow dashed line there, there's going to be some yellow dashed line there, and sometimes they're purple. That's just the highlighted volume, and I like to have mine minimum volume at 100. So that's how I get these walls here. These are just historical orders over 100. And if we look here, you can actually see that the market on the hourly dipped down. Institutions were able to accumulate their positions as price closes once, twice below this bid order, this large bid wall at 9,600, hits many traders' stop losses that they may have put right below 9,600 for protection. As you can see, we go down to, I think, like 95.95, 95.96, hits their stop losses. Institutions accumulate, and you can see it right here with that limit buy order that's over 100. And the market went right back up to a high of, I think, 97.20, 97.10. So this is just another HFT method to make a quick profit. And you're going to see these types of walls pop up. And when you do see these types of large walls pop up, watch out when they're actually filled. So, like this wall was filled right here, as you can see. And price actually was not able to go higher for a long time. It went down a little bit first because institutions were likely distributing here, selling ahead of the move right here. And some were able to sell here, and some institutions probably sold up here as well at the best possible price, not surprisingly. So these are things that you can watch out for with those historical bid and offer walls with those yellow lines there. Okay, so that's just going to be the order book for part one. The second thing is known as a spring. Whenever you see a very rapid or violent move in the order book, what you want to look for is there a bid wall or an offer wall that just popped up? So here what I had actually seen was an offer wall, bid wall immediately popped up after price went down very quickly. Some stop losses were probably here, but what's more important than that is there high demand or is there high supply? And are we going to get a demand run or are we going to get a supply run? And we can see here that we actually did get a demand run. Price went back up to here. We got a demand run because we had a high limit buy order that just sprung up out of nowhere. And these buy orders and sell orders, large ones by institutions, will just spring up out of nowhere because sometimes institutions don't want to telegraph their move like this, or like even like this, putting their buy order there. Sometimes they do, and it helps because the retail traders' stop losses are going to get hit anyway, and they're going to execute down here. But sometimes they want to hide their bid walls and hide their offer walls so that when price does approach a certain area where the stop losses begin to get hit like this, and price begins going down, you get that bid wall immediately pops up. And many retail traders are just sad that their, stop loss got hit, but price is going up because there's high demand, because institutions just got their orders filled. So that's something that you want to look out for as well. If you want to scalp, if you want a short-term trade, then master the order book and master demand runs and supply runs. And just look for, did an offer wall pop up or did a bid wall pop up? And if a bid wall pops up, then price will likely move upward after stop loss hunt. However, if an offer wall popped up here, no demand, no bids, price would likely just continue moving lower in the downtrend. Okay, so the second tool is the large trades tracker. And I talked about this, I think, a little bit in part 4 order flow. But what you want to look for here is when price moves beyond resistance or below support and then closes back in the trading range. So here we can see that price moved above resistance, hitting probably many shorts, stop losses, and convincing many retail traders that the market's just going to continue going up to at least 10K. That's going to cause a lot of retail market buying. That high market buying created this circle and this circle here. To get the large trades tracker, simply go here. It will actually be off, hit on, and I like to have mine scrolled all the way to the maximum to get the max amount of volume at one particularly price level to find that large trade. So you can see that many short stop losses and retail market buying was occurring here. What is that going to do to the market? Well, not surprisingly, that actually is going to press the market right back down. And you're going to see that with red circles as well. So when the market goes down, hits some stop losses, which it might have here, but it didn't pop up. As you can see, price went right directly below support and then went back up because it picked up liquidity of stop losses down here, and then price went back up. You're going to see those red circle pop up when price goes below support. You're going to see green circle pop up when price goes above resistance. And this is going to tell you that a stop loss hunt may have just happened. So this is just the secondary tool that you can use when looking for stop loss hunting. All right, now to my favorite tool, I think, of all types of looking for stop loss hunting and types of order flow analysis. So this is the CVD, the cumulative volume delta, that was added, I think, 3 days ago. So super new addition to TensorCharts.com. So before we start with this, I did get a lot of questions on how to activate it, because a lot of charts actually just don't, on TensorCharts, don't have this activated. So if you want to, delete the 0, because actually it'll pop up as a 0. But if you don't have it, delete the 0, click away, and then type in the 0 again, and then click away. And that should activate your CVD if you've had that issue before, because I know some people have actually messaged me that they couldn't get the CVD. So that's how you get the CVD. This is the cumulative volume delta. And what this is the running total of market buys versus market sells, one minus the other. So this number can be positive at some times. You can see it's at like 9,000, so 8,650. What that means is that that's how many Bitcoin, in this chart to be Bitcoin, how many Bitcoin were market bought relative to market sold, subtraction-wise, not ratio. This is a ratio, but this is actually just, okay, if there are 10,000 market buys and 1,000 market sells, then CVD will be at 9,000, right? And sometimes this number will actually turn negative when there's more market selling than market buying in the current market. Yes, you can see that I think around here somewhere. But yep, sometimes that number will be negative, sometimes it will be positive. It went negative here. The actual number itself is pretty irrelevant. What we're more interested in is not in how many market buys or market sells have occurred in the past, but what we're interested in is the spikes that occur. So talking about these spikes of CVD, what does that indicate? Well, when we see a spike upward in the CVD, that's going to indicate that it's a short-term period of high market buying and really not a lot of market selling. Why is there a period of high market buying? Well, A, many shorts stop losses are going to trigger as market buy orders. B, retail traders are going to get greedy and try to buy when price goes above resistance. And C, retail is going to be convinced that the market's only going to go up. So might as well market buy now, right? Because the market's going to go up higher and I don't want to miss out. So those three factors in conjunction are going to have CVD spiking like that. And when CVD spikes upward, this is actually a pretty good spot to sell. When many retail traders just market buy, that is when we want to sell. Same opposite when CVD spikes downward. We can see some spikes downward here. Beautiful ones here, actually. I see one spike downward here, rapid fall off, price went up. Let's look at the exact moment when CVD spiked downward again. I don't think it hit many stop losses, it might have, but it more just convinced retail that the market was just going to continue moving down. It occurred here. Without one bearish engulfing candle, CVD went from here to here. So price went up naturally. We picked up liquidity here, and everyone who wanted to sell has probably already sold. Same here. Everyone who wanted to sell has likely already sold in the short term, so price picks up demand. And then what we see here is CVD falls, right? And everyone who wanted to sell sells, and then price just really doesn't go anywhere. And then it falls one more time, and this is probably the best spot to buy on the chart. This very rapid fall right here is probably hitting many retail traders' stop losses. And the cool thing about this is that CVD here is actually working in conjunction with a bid wall. This is a bid wall here. This bid wall got filled, as you can see. It's not active here because it got filled by price going down to here. Retail is market selling like crazy because this is actually telling us it's basically a stop loss indicator in itself, which is, I mean, I would pay good money for this even if it wasn't free, because this is just such a helpful tool, the cumulative volume delta. Yes, what you see here is this spike downward very, very quickly. Lots of market selling, but we also see that bid orders are getting filled. Price naturally goes up, as you can see here. So one more example here that we can see. A few things. This is actually a chart a little bit more in the past. So this is not the same chart as this. If you look at the prices, 9,500, 9,300 here. We see a very rapid spike in CVD. Price actually went a little bit above resistance, previous resistance here. Retail just mass market bought in. Price went down. What a shocker. Then when price began to fall very, very quickly, CVD falls, we buy. We see a steady rise in CVD, which indicates that we probably just want to hold. A steady rise in CVD in the cumulative volume delta and a steady rise in price is a good sign for price. That is A-okay. We don't want to sell. If anything, we might want to buy. What's not a good sign is when CVD goes vertically upward. The cumulative volume delta goes upward like that as everyone market buys, because that could show us that demand has reached its equilibrium with supply. Supply is here. Demand has reached supply, which occurs here. Spike in CVD, price goes down. Spike downward in CVD, price goes up. And spike upward in CVD, and you can probably imagine where I'm going with this. That happened after that. But yeah, so this is just a really helpful tool to use in conjunction with price moving a little bit above support, a little bit below support, or a little bit above resistance. And that's where you want to look for those spikes in CVD. Not just when it's within a trading range, because that can be helpful. When I say within a trading range, I mean things like, well, actually here, price moved right below support here, right? And then price went back up because it hit the stop losses here. And then price moved below this support here to hit more stop losses. But here within the trading range, like here, this might not be a spot you want to buy in because it's not actually moving below support. So it might not actually be hitting many stop losses. But, irregardless, retail just market sold like crazy here, as you can see, because they were panicking the price would go lower and they wanted, take profit or take a small loss. Okay, so I think it is a new example here. spike in CVD. And this is a chart even more back. This is 9K to 9300. This is 89 to I think 92. Yeah, so price went up here, spike in CVD. Price couldn't go any higher because demand had reached supply. Demand run was over and price went down. Price goes down, steady fall in CVD, so I'm not doing anything yet. Price goes below support here, and this is a really good example for CVD in conjunction with stop loss hunts. Price goes below support, but there's no drop in CVD, right? Really no reason to buy in yet. But then here, price has to go down one more time so that everyone who wanted to sell has sold. And then once CVD goes down one more time very quickly like that, below support here, CVD finally falls here. The beautiful thing is price begins to go up. Any retail trader who tried to buy in gets tailed like that. And CVD just collapses as market selling just goes quite high. Everyone was market selling here. And then you get that steady, beautiful rise in CVD here that just says, hold on to the trade, everything looks fine. And then you want to sell here because, spike in CVD. I think, one more example here. Probably the cleanest example by far. Price makes support. We're expecting that retail traders are beginning to accumulate their positions. Institutions may have not finished their accumulation. Price begins to go up. Retail begins to buy, potentially. And then price goes below support very, very quickly, and CVD falls apart again. Just falls from here all the way down to here with that green line. Price goes up. Institutions probably put their limit buy orders here and had retail mass selling to them. So they got to take part in the uptrend. And you can see some smaller scale examples here if you would like to scalp. CVD rises here, it falls, and then price falls naturally. CVD spikes here, price naturally has to fall. CVD spikes downward here, right? Price naturally has to go up. So this is just like the cause and effect kind of reaction that's going to occur in the market. So I know that this video was mostly weighted towards just looking at the beauty of the cumulative volume delta. But the other two strategies do work quite well as well. And you can actually use all three strategies in conjunction with looking at stop loss market structure to try to get the best strategy for trying to hunt down other retail traders' stop losses and take advantage of them. So the last thing that I wanted to end this video with was not just presenting the theory, but presenting how we can execute on these types of theories. So there are three types of risk that we can take on when we want to enter one of these trades. Price moves below support, drop in CVD, we buy. We can be very aggressive. We can put our limit orders at stop loss clusters. So how you would do this is you could just put your limit buy order right below support. You could just put your limit sell order right above resistance. Here, resistance, put your sell order right above. That's a very aggressive way to trade into the market. And I don't know if I'd recommend that. Moderate risk is what I use. So this is trailing your entry after a hunt. When I say trailing, what I mean by that is, let's say price goes down. Naturally, you're going to want to wait for price to go down and then wait for a slight pause in the market. And then when you begin to see the market moving up, then you can just try to put your bid order to try to get filled. So as price is going up, you might get just a small little dip and then price continues to go up. And then on that small little dip, you can put your bid order to try to get it filled. You could market buy if you would like to, but it all depends on what kind of fees you want to incur. But this is just basically waiting for to trail after the hunt finishes. Then the most conservative is just wait for confirmation close in the trading range. So this is going to be the highest probability for success, but the lowest amount of reward, right? Lowest probability of success, but highest amount of reward. Moderate probability for success, moderate amount of reward. As you can see with how these work. And the conservative risk would be to wait for the confirmation close. Let me show you examples of what that would look like. You see a stop loss in here, stop loss on here, CVD goes low. You'd want to buy in around here because you can see that there's a confirmation because price closes back into the trading range, showing you that the downtrend will probably not continue. Remember, downtrends make lower lows, lower highs, and typically previous support becomes future resistance. So when price actually breaks above this previous resistance level here, the downtrend probably isn't even happening. This is probably an uptrend or maybe consolidation, but either way, you're probably going to want to buy. And some other examples here. I mean, you'd wait for a confirmation here. You could buy in anywhere here. Let's say you want to short, sure. So let's say that you see, let's say that you see this. You see a spike in CVD. Everyone's market buying. particularly want to sell here. So what you can do is just wait for confirmation for price to close below here. So when price comes here on strong momentum, you just limit sell and get your order filled here, and take profit down here or buy in for a better price later. So those are the 3 types of risk that you can take on when you want to try to use stop loss hunting strategies. All right, so that's going to be it for this video. One more thing is that on Monday we're going to be resuming the price prediction challenge, which is going to be fun. So yeah, I'm looking forward to seeing your guys' submissions for the price prediction challenge. And also, I'm still currently working on the Fibonacci course guide that will be finished probably next week or the week after that, and available for sale. So with that, have a good day.